A question we sometimes receive is, should I or can I loan from my policy to pay the premium? And the answer is yes, but it doesn't always make sense. A lot of times it does not. If one runs into trouble, if I cannot make a premium payment, there is a provision that exists within a lot of cash value life insurance policies referred to as an automatic premium loan. What this allows is the policy to borrow from itself. It borrows the cash value and then pays the premium, keeps it alive, prevents it from lapsing. However, what we've seen quite a bit recently, and we've seen this more so with IULs, is the idea of pumping money into a policy and then loaning out to add more money into the policy, compounding at a greater rate. Conceptually, it's a good idea. However, when I look at the net results of that strategy, if I borrow from a policy, I have loan interest to deal with. And yes, hypothetically, I might earn more in the policy, right? If I can earn 6 or 7% in the policy and borrow out at 4%, hey, that's a great spread and I can do a lot of good with that. The thing is, when we look at actual policy, so the original question again was, can I or should I borrow from my policy to add money into premium and accelerate the cash value growth? Look at the net yields. And I'm not talking about what hypothetically should happen based off market history. Real, actual performance, which with an IUL, that doesn't exist. I've never seen an IUL produce greater than 2 or 2.5% as far as actual returns. And which with a whole life, typically, especially in the low interest rate environment, whole life policies are likely going to produce somewhere in the neighborhood, call it between 3 and maybe a little over 5.5%, whereas most loan interest rates range between 5 and 6%. So it doesn't make sense to take out the max loan and then pay it into the policy. In the early years, definitely not. There's no possible way when I look at the net performance, net cash value of a policy. Typically I'm negative or have very low yields in the first couple of years. So if I'm borrowing out to do that, I don't want to put myself in a position where it's going to hurt me more than it's going to help me. So looking at the numbers is very important to do here. It's something we always make sure we do for everyone, but I would always look at that year to year to see, hey, does it make sense to actually loan money out and then fund the policy? Because remember, I do have to deal with the loan interest and that loan balance over time in some capacity as well. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.